spot gold has completely shattered the $4,000 barrier. It's up over 50% this year alone, making this one of the most aggressive financial anomalies we've seen in recent history. Investors are piling into the precious metal, driven by three specific, escalating fears: a paralyzing government shutdown, expectations of sweeping interest rate cuts, and severe geopolitical uncertainty abroad. This climate of unrest has led billionaire investor Ray Dalio to draw direct parallels to the 1970s. His thesis is aggressive. He's currently advising investors to allocate as much as 15% of their entire portfolios to gold. But top financial advisors are pushing back against this strategy. They caution that dumping your stocks to chase a gold rush is a severe miscalculation that could derail your retirement. This divide brings us to a crucial question. Is gold actually a wealth-generating asset? Or is it merely a psychological safety net that ends up penalizing the investors who hold onto it for too long? To understand gold, we have to look at its true functional utility. It is what's known as a safe haven asset, a place to park your money that becomes highly desirable, specifically when standard economic and political systems start to fracture. But physical gold has a strict mechanical limitation. It is a static, inanimate commodity. It produces no products, hires no workers, and pays zero dividends. Because it cannot generate its own earnings, any increase in its price relies entirely on external demand. To make money on gold, you require a buyer willing to pay more for the exact same piece of metal tomorrow than you did today. That makes gold strictly a defensive tool. It's designed to protect your capital when the world feels like it's failing, but it completely lacks the internal mechanics required to actively grow your wealth. Now compare that static rock to the S&P 500. This index is a dynamic collection of 500 living, breathing businesses, engineered to adapt, innovate, and produce. These businesses operate on the core financial principle of compounding earnings. This is the process where a company generates a profit, reinvests that profit back into the business to grow larger, and subsequently generates an even larger profit the next year. On a microscopic timeline, gold's 51.6% return absolutely crushes the stock market. But expanding our view out to 30 years, the math changes. The S&P 500's 10.67% annualized return ultimately eclipses gold's 7.96%. Short-term crises will always create temporary, explosive spikes in commodity prices. But over 3 decades, the mathematical certainty of compounding earnings defeats the unpredictable surges of panic buying every single time. So how should a rational investor use gold? Based on its mechanical limits, you should treat it strictly as a localized insurance policy rather than the engine driving your retirement. If you do want that insurance, experts advise avoiding the logistical friction of buying and storing physical bars. Instead, look to a highly liquid, gold-backed exchange-traded fund, or ETF, which tracks the metal's price without the need for a personal vault. This is the foundation of a normal times approach to wealth management. While a small insurance policy is useful for worst-case scenarios, your portfolio must be primarily built for the most likely long-term outcome: ongoing economic growth. That is why top wealth managers directly push back against Ray Dalio's 15% allocation. The broad consensus caps gold exposure strictly at a low, single-digit percentage of your total investments. The functional difference between the two assets comes down to your ultimate goal. You buy gold to survive a fractured economy, but you buy equities to actually thrive in one. As top advisor Pat Beard put it, gold glitters, but earnings compound. When it comes to generating long-term wealth, the stock market remains the mathematically undisputed champion.